Welcome to Lecture 7B. We're going to do the introductory description of what we'll be doing for the next, actually almost for the entire rest of the semester, which is we're introducing a model of the accounting system as a metaphor, meaning a system that is done the traditional accounting way. And then every chapter after this, we're just expanding that metaphor. It's becoming more and more complex. So stay on this. And if we have a firm base that's built here in Chapter 4, it will be a little bit smoother for you to progress into the later chapters. Right now, I'm going to be outlining what's ahead of us so that you can have a model of the next steps for you. We are moving down a path, like I said, of the metaphorical accounting system. By metaphorical, meaning it is a system, but what we're doing is the traditional metaphor of what accounting is. In fact, in Chapter 4, you also have an example of how accounting is really done today, which is through a relational database. And you can see that the relational database is richer and it will be more effective. One of the problems is, though, that you have to communicate with people on the traditional basis, and you have to pass your exams on a traditional basis, so we're going to nail that one down first. I do have to say that one of the things that your preparation is extremely weak at, almost non-existent, is you have almost no preparation in how accounting systems really work, meaning the database-driven section of the accounting systems. And the only way you can do that is to write one yourself. You know, you can look at what other people do all you want, but ultimately in your gut, when you write it yourself, that's when it makes sense. Now, just like a spreadsheet, you know, in this class I have you do spreadsheet assignments, but the assignments are pretty small. They're really challenging, but they're intended just to challenge your brain. They're not really full-scale, you know, assignments. That's what I'm talking about for database programming. You should be learning, you know, to be an accountant today, you really can't be a fully rounded, competent accountant today without having substantial knowledge of database programming. You can have, you know, a career that makes sense, but you're trapped by other people's learning. You know, that means that you're going to use only software that was handed to you, and you're afraid to modify it. And I don't know if you know this, you can modify QuickBooks. There's an SDK. SDK stands for Supplier or Software Development Kit. And basically, QuickBooks will sell you the software that allows you to open up QuickBooks and get in and reprogram QuickBooks to be better and quicker for your clients. And there are companies that make their business doing that, you know, with Excel or other software. This is where you get a lot of hyper-customized programs. For instance, accounting software for poodle grooming parlors, accounting software for nail salons, accounting software for massage parlors. Those have been customized for the needs of specific clients from more general things by people that just went in, mainly accountants that went in and knew some coding. They went in and made the changes that would be really important for a specific subgroup of customers that the main company just couldn't afford to support. One difference we have is, of course, in Canada. In Canada, what we do is it's like 95% the same as what happens in the States. But you know what? 95% is not even close to being as good as you need. So, you know, if you can get into using the SDK and reprogram some stuff, that means that you can take any U.S. software, even their, you know, tax, well, not big tax software, but the tax portions of QuickBooks, you could modify them fairly in a straightforward way to be used in Canada. Now, it happens there is a Canadian version of QuickBooks, so what I really meant was an example of a piece of software that was sold only in the U.S., that has some minor tax calculations. With a little small amount of database knowledge, you can go in and reprogram it, and then all of a sudden you'd have a product to vend. Or you could do it in Excel. You know, so there are a lot of people that make money, you know, doing this. But it also makes you a better consumer. It makes you a better buyer. If you're, you know, one of the things you'll do in your career a lot, either giving advice to friends in your company about what accounting software to buy or to use. If you don't know something like a fairly big amount about database software, I guarantee you're not going to make the right decision because you just lack the competence to even know what the trade-offs are, to evaluate the trade-offs. in any reasonable sense. If you're really a good listener and you get your computer people to, and you ask them question after question after question, like, I mean, weeks and weeks worth of questions, yeah, you can get the stuff on the table, but you have to be really incredibly persistent and have people that you're willing to actually just work with you for day after day after day to come up with the questions and answers. Like, they have to stop doing their work in order to fill you in on the strengths and weaknesses. So it's a big loss, but you know, the curriculum is so packed and none of the stuff's on the CPA exam, so it's not there. But chapter 4, the end part, is giving you the idea of how you would approach that. If one thing you'll notice, if you look at that chapter 4 example, it's much richer than our accounting. Mainly, we say our accounting system, the metaphor we use of debits and credits, is a system to record important economic information. It's actually mainly a method to destroy important economic information, because we actually record and save only a tiny fragment of what's important. Because it was a system developed in the 1500s when all they had was paper. They didn't even have paper actually at that time. They were recording on parchment, which is animal skin stretched out and stuff. Or, you know, and then they started having a lot of paper right around that time. So our system is actually not designed to record much at all. It records just the bare necessity that you need for certain purposes. Most information in a transaction is ignored and destroyed. So if you look at that example at the end of chapter 4 and you can look at what is actually kept, you'll notice that in the database form, you can keep almost everything, and that means you can find it later. This is a mental box for accountants. If all you know is the accounting metaphor, debits and credits, then if you start to think that that's all that's actually in there, then you don't ask these other questions. Now let me give you one example right now. After you write this down, it's just like 1 or 2 sentences, and then go look at the example I gave you and see if it's not true. Notice that in chapter 3 and in the other discussions of quality, having things arrive either early or late is very bad. Because if they arrive early, you may not have a place to put them. If they arrive late, you can stop production if your lot size is very low. So both early and late are just more or less disasters. Well, how can you figure out, you know, let's say you have, for one raw material, so one of your inputs, you have 5 vendors. How can you say, like, instantaneously, which vendor ships early or late, or which vendor actually is always on time? Well, you try and do that in a standard accounting system, you are in for a world of hurt. You're going to have to go back and reconstruct on a spreadsheet, you know, the arrival time, you know, the promise date, you know, when it was promised, when it should have gotten here, and, you know, when it actually arrived. But go back and look at that database example in chapter 4, and you'll see that actually all you have to do in there is, if in recording your information, you, for every time you order something from somebody, you just put in there the date that you ordered it and the date it was promised. Then when it arrives, you type in the date it arrived, and all you have to do is write a little code in SQL, which is structured query language, which you should know. And you just write list all document, you know, all incoming receipts. There would be a technical name for that, but we haven't discussed it. So list all incoming shipments where promise date is not equal to receipt date. Boom, and and then say for the period, you know, January through March 2020. You need to put a date thing, otherwise you'll get stuff from like the last century. All of a sudden, boom, the report's there. It's in there in one instant because it's in the database. You have it, the information there. You can get it instantly. If you don't, if you're thinking the old accounting metaphor, you may not even ask that question because it's so onerous. You think, oh my God, I can't send this. You know, like I'm going to have to send a staff member, a co-op student, into a room for like a week to figure this out, or at least 3 or 4 hours to pull those receipts and check all the invoices, check all the shipping and receiving reports. You know, so you actually stop yourself from asking questions if you're too closely tied to the accounting system. Okay, so it is the accounting system itself. Its existence is a mental block for you going forward because it's hard. Doing what you're doing is really hard. It's really hard. And you're going to learn all this stuff. And then the problem will only happen if you if you stop your learning at the limits of the accounting system. And a lot of people do, because even maintaining your knowledge of the accounting system is just flippin' difficult. There's so much stuff out there. So by expanding to other things, knowing how the system actually works, then the accounting system, of course, is not bad. It's great knowledge. It's when that knowledge puts you in a box of you not realizing there's other knowledge out there. That's when there's a problem. So in this chapter, you're going to see at the end an example of how accounting systems are really done. I promise you, there has not in the entire world been an accounting system written in the last 20 years that's based on debits and credits. Maybe even longer, maybe 30 years. What they're based on is what you see in chapter 4, the end. They're based on a relational database concepts of records and attributes. But in order to fool the old accountants, what they have is the reports that are generated. The reports are formatted to look like there are debits and credits. But in fact, notice when you look at that database diagram, there's nothing on there that tells you something is a debit or a credit, because it's not in the system. That's something that's imposed in the report structure after the system, which is another reason accounting systems are complicated and expensive and full of mistakes, is that smart recording of the information requires ignoring debits and credits and just trapping all the information. But you have a whole system of people whose mind is locked into this accounting thing. So you have to write an entire layer of translation software to then make everything appear as if the debits and credits actually were in existence. And most of the accountants don't know that they don't exist. They actually don't know that they're not looking at the system. They think they're looking at the system. They're actually looking at a report generated and definitions of debit and credit that were added on at the report stage, not in the actual database itself. So anyway, that's just a little FYI for you. Focus on the CPA exam right now. And in the back of your head, a few thoughts like learning Python and different things like that. That's going to expand your horizons already. And then if you learn relational database programming, that would be a little bit more focused on the accounting system maintenance. So what we have then is a set of accounting systems that we're going to learn on. From now to the rest of the term, we are going to move down a path from actual accounting systems to normal cost to standard cost. These are philosophical changes in the underlying ways that we approach the measurement. So there's giant differences. Over your career, you're not going to see much of this. Maybe if we have that, it'll look more like an actual. You do have it if you have small clients. If you're in public accounting and you have small clients that are using QuickBooks, or whatever, some equivalent like that, that is actual costing. So in certain cases, some of you will have some contact with actual costing for your whole career. Most of you will not. As soon as you move off to an organization that's a little bit bigger, even like 30 or 40 people, and you're doing something else, like you're part of healthcare, hospital, medical clinic, manufacturing, restaurant chain, that type of thing, you're no longer doing that. Okay? You've moved to here, and you might have moved to here. What's different is whether you're using actual transactions or forecast transactions inside the journal entry structure. Here, actual costing, journal entries happen only through actual transactions. Now, one thing this means is that this system is only accurate at the end of the business cycle. That you cannot use any interim reporting in an actual cost system because a lot of the transactions haven't taken place yet. So it's completely erroneous. Like monthly, quarterly, daily, weekly reports, I guess you could run them, but they don't really mean anything. Or some pieces might mean something, but there will be giant holes in the information. So taken as a whole, the statements will be always completely misleading. There will be certain line items that might be, interpretable, but most of them not, because you never record anything until the transaction happens. We have a lot of transactions that don't happen, but like twice a year, like paying your insurance bill, right? You might be paying insurance only once a year, twice a year. What happens if you run a monthly report before the insurance payment? Well, that whole line will be zero. For like 2 or 3 months, you'll have zero free insurance. That's actually the truth, but that doesn't tell you about the economic impact of the $25,000 check you're going to write 2 weeks from now. Okay? So actual costing is totally accurate at the end of the business cycle. And this is cheap, so it's accurate there. At all intervening times, not accurate. Okay? So, for instance, it would never meet any kind of gap disclosure for interim reporting. Right? So it can be totally gap for the end of the year reporting, but if there's a gap standard for interim reporting, you'd have a problem here. In fact, I don't think I've ever seen a pure actual accounting system do interim reports. But anyway, so that is the issue you find here. These would be small. It's fine for taxes because remember, you always do your tax reporting significantly after the end of the year. So in effect, taxes are always the tax reports are always done at the end of the business cycle. They have some early stage submission of interim payments, but the actual reporting of the true obligation is always done well after the business cycle. So it's actually fine for tax purposes, and it's fine for annual reports. If a bit odd, because by the time you do the annual report, the business cycle's over. It's totally accurate, no problems here. Okay, we move to normal cost. What's happening is the difference here is you're going to use a forecast. The forecast is going to be used often to generate interim information and journal entries. That forecast is introduced in Chapter 4, and you have seen it before, but they probably didn't call it a forecast. I'm using that language to be a bit provocative, because it is a forecast. It's one we do so often and so regularly, we often don't step back and say, oh, that's a forecast. This is in our book known as a POR, predetermined overhead rate. A predetermined overhead rate means that you estimated overhead for the year in advance, and you have figured out how much overhead you think will be used by each action, like by each product or each consulting engagement or each audit engagement or each tax. And you said, okay, whenever we have a client, for those of you that are in public accounting, I don't know if this was your first work term, you may not have actually seen this. They have an overhead charge for each client. They may not use the word overhead, they'll use some other word, but there is a base charge that says each client has to pay a certain amount, and it may not be the same lump sum for everybody. There may be certain different types, or based on the number of hours that you work, there will be an additional charge. It's the overhead charge. The only way you would know about that is if you did a budget and you did a forecast to say, okay, next year we're going to spend $1 million on computing support. So we need to make sure that our customers pay that during the year. So we're going to do our little forecast, and we're going to say $1 million in computer support, and we expect that our workers will work for, say, 20,000 hours. We're going to take $1 million divided by 20,000 hours. That's going to say this is what our guess is of how many dollars of computer support are going to be used by each hour of employee work. And that is a forecast. So we're going to pick this up. In our book, we use this language. And we're going to use, on some pages of your book, you're going to see this initial like 25 times. It's going to be used from now to the end of the semester. Predetermined overhead rate. You've now moved into a much more sophisticated accounting system because you have forecast what you believe is an accurate forecast of your overhead costs, and that's a big trick to do. It's hard to do this. So these people down here are doing actual cost because they don't know how and don't have the resources to forecast a budget. So you have forecast your overhead, and then you are going to divide that out and charge it out to your clients. This means that you can have in this system, you can actually have an interim report that means something. You can have daily, weekly, monthly, quarterly reports, and they will be interpretable, because all of those things that come in lumps, like insurance payments that you only make once a year, or other health payments that you don't make every day, but you only make them once every 2 months or something like that, even some utilities bills, or some things that like property taxes are only due like twice a year, things like that. You've put them into your forecast, so that means that every week you have, or month or whatever, every time period you believe you have pretty close to the correct amount of the allocated expense. This then is how we allocate lump sum expenses across time periods. We even things out. So it actually is one of the ways we even these lumpy expenditures across time periods. So predetermined overhead rate, it's actually a giant philosophical leap into how we operate. It does create problems because these estimates are never accurate. Just as like trying to do a good job, they're always off somewhere. If you're really superb, then what you'll get is maybe they'll be plus or minus 10% over a period of years. Like it'll be 10% over, 5% over, then 10% short, 10% short. You're never going to get that close. But if you don't do your best, you won't have this, meaning you have no interim reports. And you can't tell if a job is profitable. That's probably the wrong word. You can't guess about whether a job or a client is profitable unless you do this. So that means that if you don't do this, you really don't have a reliable way of knowing whether you should accept a job or a bid from a specific client, because you don't have a good method for knowing the full costs. Particularly in construction business, you have to do this, right? Otherwise you don't know what to bid on the house that you're bidding on. So the giant intellectual step. And what we have here is, in our class, we introduced this in chapter 4 in sort of a baby method. It's not a baby method, it's hard, but in a basic method. So chapter 4 is the basic look at the system, and we introduce a lot of the pieces, but only in one alternative and the most basic, simple thing, because we need you to get on this bicycle, okay? Then chapter 5 is actually just chapter 4 again, except we go through a lot of the pieces and we add the realism to them. And you know what? It becomes a lot more difficult. So really try and nail down chapter 4. You'll find that chapter 5 becomes doable because you've steadied your knowledge of chapter 4, the whole system. And then when we start making things complex, like in chapter 5, one of the things we're going to make a lot more complicated is this, because we're going to go through what happens when you have under or over applied overhead and why. And you have to know why. And it's not actually part of the accounting process. It's part of the budgeting process. So you can't actually do the accounting thing called over or under applied overhead unless you actually know pretty well how budgeting fits into the system, even though budgeting is not part of, quote, the accounting metaphor, the debits and credit system. It's an outside of the debit credit system piece of information that you have to process in order to get your debits and credits correctly. This comes in chapter 5. So if you're a little bit shaky here, like if you haven't done enough practice here, this is going to be, a problem. Then the big line here is from here to chapter 7 and 8. Now, we don't do the journal entries until chapter 8, but we do the analysis in chapter 7. And what happens as soon as you cross this line, this POR idea goes crazy. It becomes, the crazy wild child of accounting, which is we now forecast everything. In the factory, okay? So if you think about this, forecast overhead and POR, okay? This is now forecast everything in the factory. So standard costing is production. And when we're talking normal costing in the classroom, it's also production. So we're not talking about general accounting, we're talking about just the accounting for a factory at this point. Also, I forgot to mention this. The only time you're going to see the word normal costing is basically in accounting textbooks. All the textbooks, or most of the textbooks, use that to define this, that we're forecasting overhead and using a POR. That's what this means, normal costing. But you never, this word, I don't think you'll ever in your life see it once you leave university or leave these textbooks. It is not a word that's used professionally. I think part of the reason is because professionally, you don't really use this except for your cigar box, shoebox clients actually, cigar box. I don't know if you guys use that term, but that was a term we used to use. A shoebox client is a client that brings in all their data in a shoebox, like all the receipts. You're not going to use this much unless you have a public accounting firm that has a lot of really tiny clients, okay? So most professional accountants will never see one of these because they're going to work for organizations. If you work for an organization, this is the minimum you can do, so they just call it accounting, okay? So this distinction, normal costing, is a textbook kind of distinction, but we will use it, and there will be questions. Questions will appear on the exam. What do you do in this in a normal costing environment? This has to click into you that we're distinguishing and talking about this. Now this, standard costing, is normal costing gone wacko. It's the most sophisticated accounting system. Well, actually there's another exception I just thought about, but I'll tell you about that in a second. It's the most sophisticated accounting system that you'll normally find in a commercial business. And that is, we forecast everything. And this idea of PORs, we get PO everything. So we will do predetermined labor rate 1, predetermined labor rate 2. Like if we have 2 different classes or 5 different classes of labor that work in our facility, we'll have a predetermined rate to make, like, what was the example I used before? Making calculators. So we're making calculators. So on the calculator production line, we'll have predetermined labor rate 1. It's not overhead. It's the direct cost. Predetermined labor rate 2. Predetermined labor rate 3. Then we'll also have for every raw material. For the calculator line, we'll have calculator line, predetermined backplate plastic 1. Predetermined red keys 1. There's no red keys, blue keys. Predetermined, okay. So every raw material input that you have, every raw labor input you have, and every overhead you have is going to have a predetermined equivalent. So this is a reason that we really need to get this knowledge steady before you get into chapter 7 and 8, because all of a sudden this idea of a POR, every journal entry you have is going to be based on a POR, and the problems that exist, like that over and under applied overhead rate, that will exist on every single line item in the system. Every account will have an over or under applied journal entry. We don't call it over or under applied. We use different language. We call it a variance. So over here in this system, there are going to be variances. One of the paradoxes here, in a standard costing system, there's no accounting account that has an actual cost in it. The journal entries are all based on the standard cost, right? The predetermined, the POR kind of cost, except we call it the standard cost. And then there's another accompanying nearby journal entry. It's done at the same time that has the variance in it. So the accounting system itself actually has only standard costs and the variances. If you want to know the actual cost, you can figure it out. What you have to do is take the standard cost and the variance and add them together. And the variance can be positive or negative. Then you can always figure out what the actual cost is. But inside a factory that uses standard costing, there is not a single account that actually has an actual cost balance or a journal entry that has an actual cost as a line item. The actual cost can be derived, but derived because you would know the predetermined amount, which we call the standard amount, and you would know what the variance from the standard was. So basically at this point, your eyes are going to roll in the back of your head and you're going, oh my God, what am I doing here? The level of complexity goes sky high. And it's sort of starting off here, lower, gets higher here, chapters 7 and 8. Chapter 7 and 8 are really more like one chapter, but one gigantic gigantic chapters, so they were too embarrassed to put them into one. So chapter 7 is actually developing the standards, knowing what the standards are. Chapter 8 is implementing the standards in the journal entry system. So this will be very difficult. But it's helpful if you know why you're going places and what the places are. The place you're going is, you are going to learn in this class a sophisticated traditional model of how accounting systems work in the traditional accounting metaphor. You're not going to know the underlying database and everything that goes on there, but you will, through a lot of effort, learn how the metaphor works, meaning the original metaphor of the debits and credits and accounts. This is chapter 7 and 8. Standard costing has both content and it's a system. So what we're learning in chapter 7 and 8 is a system of using standard numbers, but we're also doing the traditional approach to what's in the system. So the content in 7 and 8 is traditional, and the system is using PORs and standards. In the following chapters, we will actually be doing ABC at the level of the system. ABC and standard costing are the same. Okay? The content is different, but actually the costing word, meaning the journal entries that are implied and what's in different accounts, is the same as, quote, standard costing. It happened that we didn't change the language because standard costing was around for 100 years. Then we invented ABC, and people, especially at the beginning, just weren't really careful about their language. So when we get to chapter 10, which is activity-based costing, we'll see that the system itself is the same as the standard costing system, but what we choose to set a standard on, the content is different. But the way the system works, meaning everything is done at standard with a variance, that's actually the same in both ABC, in standard costing and ABC. So standard costing, historical accident, anytime you hear this word, they're actually talking about an accounting system, but also talking about the traditional way to cost things based on departments. When you hear the word ABC, you're going to say, oh, you're going to need to realize the system is the same as standard costing in terms of the flow and pattern, but the content is no longer about departments. We're doing activities. So if we were really good guys, we would go back and change this to say departmental costing. And we would change this to say, and then this would be activity-based costing. But, you can't go and change a bunch of old stuff. The other thing is, another observation here is there is a big brother of this called GPK. It's the German version, which is what we should all be doing, but it's not. There's not many examples of it in North America, although there is a hospital in Toronto that does use this. So GPK is really a much more sophisticated version of standard costing, where they've taken extra care on a couple of pieces that we tend to be sloppy at in the Anglo-Axis. So GPK is German. You can look it up if you want to be a real accountant, later or sometime in your life, or implement something. Yeah, I would give heavy consideration to this. I think this is the one I would always advise people to. GPK stands for Grenzplankostenrechnung, which is one of those giant German words that basically means cost and planning system. They have giant words there. German is what they call an agglutinated language, meaning they form new nouns by taking nouns that they have and jumping them together in the writing system. We actually do the same thing when we talk. Like if I say to you activity-based costing, you think of that as 3 words. But if you were a non-native English speaker and a little bit rough with your English and you heard me say activity-based costing, you wouldn't actually know what the division between the words was. It would sound like one, sort of word to you. There are several languages where what they do is they just write those down. They say it more or less the same thing we do. But when they write it down, their orthography or written form, they actually write it down as one word. So all of a sudden they end up with these big flipping long things, and to us it seems crazy. What they're doing is they're just writing down closer to the sound that they say when they do it. But it's a bit embedded in the way they think about their own language. A lot of languages do this. It's like Turkish, German, all the Nordic languages, Swedish, Norwegian, Danish, also Finnish, which is a different language. They are also agglutinated. So anyway, just a little side trip there. But GPK It's what we should be doing. It's a smarter form of standard costing. But we're running out of time in your semester to teach you that. The difference, though, I will discuss when we get there. The difference is actually pretty simple in a way, but it makes the system totally different. In fact, a good GPK system has accuracy that's very close to the accuracy of what you think an ABC system might be able to do, but less than half the cost and less than half the craziness that you would find with an ABC system, which are sort of unimplementable. So anyway, that is the discussion. That's where we're going. Okay, stay focused. Really try and focus on 4. The next video, 7C, we'll get into the meat and potatoes of 4, and we'll go walk through the journal entry system. I'll talk to you about that, talk to you about how we'll approach it, and see how it comes together as, quote, a system, meaning the accounting metaphor of how we're trying to keep things together. And I will be back for lecture 7C.